get right now to an economist, Brian Fabbri. He's our guest for this segment. He is with BNP Paribas. And Brian,
hi.
You've been watching this testimony by Bernanke as well, but at the same time, keeping an eye on the markets. How much of what we're seeing in the markets right now is being affected by what Bernanke is saying about the economy?
I'm not really sure that the market's current movements are really Bernanke inspired. As we saw yesterday, I think the markets interpreted Bernanke's speech and his testimony in the Q&A in a relatively positive way. I think he reassured markets that he would maintain low rates for a very long time, and I think markets are now anticipating that to be through the end of this year at least. And I think he's covered all of his bases with respect to taking away liquidity initiatives and building a process, a tactic, if you like, for removing some of the excess reserves. And I think the markets are comfortable with all of that. I don't think he's changed anything serious, any meaningful things in his Q&A today. Obviously, it's the same testimony. But as he said yesterday, the big issues are we're much more concerned about unemployment and new job creation than we are about inflation. There is no inflation problem right now. And secondly, commercial real estate is the big issue that's going to be confronting small and medium-sized banks. And there is not a lot that the Fed at the moment can do about that. He's indicated that the Fed is always watching to see whether or not some new initiative will be needed, depending upon whether or not there's downward surprises to the economy. And so I think he's done his job with respect to answering those questions. I think he put the...
Well, then can you interpret what we're seeing in the markets as perhaps a surprise to what we've seen in the economic data, then, this downward surprise? And we did see some weakness in the durable goods orders. Might that be an indication to the markets that we're going to see more negative surprises going forward?
I think if we take the last couple of weeks, the last 2 weeks of data, we've seen an awful lot of big surprises. The housing sales statistics were absolutely dreadful. The unemployment insurance claims for the last 3 or 4 weeks have been increasing. I think the market got into the comfort zone of watching them decrease over the end of last year and really even through January. And now suddenly they're rising significantly. And it seems to suggest, obviously, that the private sector is not yet at the point of hiring people, and they may still be in a firing mood. Most of the rest of the data that's coming, the consumer confidence data from last week, was startlingly weak. So I think all of a sudden the markets are wondering, have we seen sort of a stagnation in the economic recovery that took place during the second half of last year? And I think that's a very palpable problem, especially when
Brian, let me jump in and just ask you, do you think that given the numbers that you're talking about, is Ben Bernanke's portrait of the economy, is it too rosy? He's talking about a nation in recovery. Is it too optimistic?
It may well be. I don't think anybody, including us, thought that we'd see this downbeat set of data, and really even durable goods. When you took Boeing orders out of durable goods, it really wasn't particularly nice. It was a very downbeat set of new orders for the new year, and consequently that will lead us into business investment in the new year. Frankly, I think that this set of data is a surprise, and I don't think he's really reflected on it. No one's really asked him about the current set of data.
But didn't he acknowledge, though, and also others have as well, that weather has played a factor in some of this data? You may see worse than expected data because of the fact that we've seen snowstorms, it has disrupted business and so forth?
The weather question is just that. It's a question mark. If it's just simply a temporary setback because of weather conditions, then real GDP growth in February probably will be lower. It may be made up for in March, or it may be made up for as we get into Q2. But it does look as though it's going to weaken a sizable component of Q1 GDP.
Brian, appreciate you joining us. Thank you so much, Brian Fabbri, Chief Economist at BNP Paribas.